Welcome to the Smart Business Revolution.
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 You want a revolution?
You say you want a revolution?
Revolution. The revolution.
It's going on right now.
Welcome to The Revolution, the Smart Business Revolution podcast, where we ask today's most successful entrepreneurs to share the tools and strategies they use to build relationships and connections to grow their revenue. Now, your host for The Revolution, John Corcoran.
All right, welcome everyone. John Corcoran here. I am the host of this show. You guys know my story. I'm a recovering political hack, recovering lawyer, spent years working in politics, and also practiced law for a bunch of years. And 10 years ago, I discovered this medium of podcasting. I've been doing it ever since. And over 10 years of hosting this show, I have had the great privilege of talking with so many great top CEOs, founders, and entrepreneurs of all kinds of different companies and organizations, ranging from YPO and EO to Activation Blizzard, Lending Tree, OpenTable, and many more. I'm also the co-founder of Rise 25, where we help B2B businesses with the strategy and production they need to create a podcast that produces tremendous ROI and connects them with their ideal prospects and referral partners. And before we introduce today's guest, I want to give a quick shout out to my friend Dove Gordon. Dove Gordon is a great guy. Google his name. Real giver, and he's got a group of different business owners that my guest and I connected through, and I've been a member of it for about 6 or 7 years now. Just a bunch of giving business owners who support one another, exchanging ideas, exchanging introductions, supporting one another, and I just love the philosophy behind it, and so that's why I've been part of it. So my guest today is Neville Joffe. He turned his 400 unionized employee company back to profitability through profit sharing with his employees. The success was largely due to him teaching his employees the financial implications of their decisions. And he subsequently developed and patented an award-winning interactive multi-sensory game-like tool to teach business acumen to non-financial business leaders and entrepreneurs. And over the past 22 years, Neville has brought his work to many global companies, including IOTA, Hallmark, Bombardier, Campbell Soup. His financial literacy training programs have transformed corporate cultures at all kinds of different levels. He even was a past case protagonist at Harvard Business School, which is quite a big honor. So we're going to get into that in a second. But first, before we do, this episode is brought to you by Rise 25, which helps B2B businesses to get clients, referrals, and strategic partnerships with done-for-you podcasts and content marketing. We specialize in B2B businesses with a high client lifetime value. So to learn more, go to rise25media.com. All right, Neville, I'm super excited to talk to you. And I want to start with a story you write about in your book. The book is called The Baker's Dozen Rules of Highly Successful Business Operators. Super cool book. Looks like a cookbook, which is really neat, the way that it was all laid out and all that kind of stuff, which is appropriate. But you tell this story of walking into this factory of 400 people and doing something a little bit shocking. So I'll let you tell the story. What happened? What did you do?
Hey, John, actually, I did a lot of shocking things, but this one is particularly interesting. This is in the early 90s, late 80s, early 90s. We were facing a lot of financial stress, largely due to NAFTA at that time, high level of inflation, and really dealing with a deflationary environment where consumers were not paid to pay more money, but way going up. So we got into union negotiations and they made certain demands that had we met these demands, the company would have got bankrupt for absolute certain. So I called in the union and I said, look, we need to do something in this organization, we're going to change it forever. And that's in the interest of all parties. Because by signing this deal, we're not going to last long. So I have a philosophy that nobody washes a rented car. There's no sense of ownership. Mm-hmm. So using this thought process, I managed to secure a wage freeze for 3 years in support of a gain share program. Now, a gain share is different to profit share. Profit share means you share all the profits. Gain share means that you only share the incremental gain above a certain hurdle rate. Mm. But it was really hard to get our non-financial employees at every level, blue collar and white collar people, to understand the financial implications of what they did. Mm. So the first thing I did was I had our internal accountant teach it. Bad mistake. Understanding it and teaching it are two different things.
What was that like? You had an accountant come out and try and teach you.
So It was so painful, John.
Oh man, I can imagine. Yeah.
Yeah. Then I called in a college prof who simply did the wrong thing more efficiently. In fact, that's the name of one of my chapters. Don't do the wrong thing more efficiently. That's where I got it from.
That's funny.
It's all bookkeeping on steroids. I thought this is not going to work. So I thought, and I'm losing a lot of credibility, with the union and with my partner, by the way, who was a generation older than myself, who was totally opposed. Who was totally opposed to financial transparency.
Mm. And at this point, were you transparent?
Transparency.
So at this point, were you transparent? I mean,
not at that point.
Okay, so you're marching down that road.
I tried to become financial transparent. But he was totally opposed to it.
Mm.
And I thought, what am I going to do here with this? Because I knew we could scrape the profits off the floor in this company. So I called a meeting, and I cashed $1,000 in small bills, and I crumpled them up into black garbage bags, and no one knew a thing about this. And I called a meeting with the union, with all the employees, with my partner and his family. He was a founder of the company, by the way.
And his family there too.
Oh yeah, his family there as well, because they were on side with. Anyway,
how long had you bought into this? You bought a minority share in the business. How long had you been around at this point when you did this?
This was about my 4th year into the company.
Okay, so you've been there for a little bit.
Yes, we got the company stable. With the banks, we weren't making any profits really to speak of. We were out of trouble. But I always had this vision of Inc. magazine coming with a video camera and filming this model company. I could taste it. I just couldn't get there.
Yeah.
Standing on these tables at the back of the factory, I had all these bags of cash. And I said, I know you've all struggled to learn this stuff, but now I'm going to give you a demonstration that you will never forget. And everyone looked at each other, thought, what's going on here? And I turned these black garbage bags upside down and I poured out all this cash. Everyone looked at this thing aghast. I think, what? Then I took handfuls of cash into pre-label, and I put them into pre-label buckets, called labor, fabric, process, rent, and so on. And then I had a bucket called waste. And I had some $20 bills in my pocket, and I pulled them out and I started tearing them up. And I put it called waste, and people were freaking out. I said, why are you freaking out? You do this every day.
Mm.
I did tape them together again afterwards, but no one knew that. And then we had some cash left at the end, and I said, this is called profit. I cut the pile in half, and I said, this half is for the owners of the company for the risk that is taken to keep these doors open. The other half is for you to share equally between each other. Equally being the operative word. And everyone looked at each other and thought, well, hang on a second. The guys in the office were telling me, but Neville, this is not reasonable. I mean, it's not fair that somebody who's earning, they didn't give numbers, but let's say 60 grand a year working in an office. Why should we get somebody working on the shop floor earning half the amount, earn the same amount as me?
So you mean totally equally? So if there's
totally
there's
equally.
10 employees, there's $100 in profit, then they each get $10, even if
Correct.
one of them made 100 grand a year and one of them made 50 grand a year.
Exactly.
Okay.
So I said, here's why. You get paid a salary for your skill, and you get paid a bonus for your heart and soul.
Hmm.
I have a huge moral issue paying somebody who's earning 100 grand a year, who comes to work, they just do what they're supposed to do and go home, getting the same amount of money as somebody on the shop floor who's always willing to help, always coming up with new ideas, always going above and beyond their expectations and putting their heart and soul into the company. So each of you will be considered like equal shareholders. In other words, each of you are getting a dividend. I never had another argument on that one.
Wow. After that, that's a great argument.
But a lot of good things happened, John. What happened was suddenly there was collaborative effort going on. There was teamwork because they all became accountable to each other. There were some interesting arguments and very colorful conversations between the salespeople and the factory floor because I taught them the theory of constraints, got them to understand the use of scarce resources, and starting to educate them to help them understand how the efforts and product mix and customer mix and so on could generate more contribution towards overheads in the company. This was a learning curve for them as it was for me.
That was a lot to unpack what you just said there. So explain that to me, these arguments between sales and the floor.
Okay, so one of the chapters in my book are revenues are vanity, profits are sanity, and cash flow is reality.
Yep.
They all used to govern the success of the company based on the fact that they're working 24/7 or really busy and generating revenue. What they didn't connect to was the word profits and cash flow. So the metrics that I had to create and the understanding I had to get into their minds using various forms of communication, a lot of them unorthodox, like one of them was tearing up money. I didn't do that again, by the way. But just help them understand using context and using language they could understand, because they weren't stupid. They just weren't trained in the skill.
Right.
To understand the implication of profit, understanding what they were selling and to whom, understanding the whole power of product mix and customer mix. I'm putting together here 3 years of education into just a few minutes. Yes, it's a big topic, worthy of a lot of discussion. But the long or the short of it was, not everything interesting is useful. It's another chapter of my book. Not everything interesting is useful. So I simplified everything through using KPIs and metrics that they could control.
Each person.
That they could control. So we shared financial information that was meaningful to them, that they could control and be rewarded as a result thereof. Another big topic here for the listeners here, John, is that I had to create an environment where I had the license to make mistakes. Because they were just waiting to shoot me down on this. So I told everybody, we are going to learn together. We are all going to make mistakes, but we're working for common ground and common cause, common agenda. We all want to be enriched as a result of our collective efforts in this company.
And how did you see behavior start to change as you got them to buy into this vision?
It was remarkably simple, but not easy. Another chapter in my book, I'm making reference to this because that's what this is all about, is that you need to measure to manage. You cannot manage a business, you cannot manage your health, you cannot manage anything if you don't measure it.
Yeah.
So I created simple KPIs, and every Monday morning we would analyze the results of the previous week with flip charts in each department, and going through them and debating them and discussing them and pressure testing them. We would work through the good, the bad, and the ugly, or what did work, what didn't work, and how we would manage it. But we also use what I call a concept called quality circle. Have you heard of this? Quality circle. Quality circle is a Japanese philosophy of communication. We would literally stand in a circle at each of these departments. We did it also globally from all the departments, and discuss what I should teach, the theory of constraints, understanding the constraints in the organization that might stop you from achieving what you need to achieve. So the salespeople, in answer to your earlier question, the salespeople may say, we want to get out 5,000 units for this week. Okay, 3,000 of which are customized. So let's go through the constraints. Do you have the fabric? Yeah. Okay. Do you have the design capacity? Yeah. Do you have the sewing capacity? Yeah. Do you have a particular resource like a folder or something? Somebody said no. Okay, there's your constraint. So until you can elevate the constraint or find the resource to deliver that part of the process, this order is not going to go out. So they learn to understand constraints. Constraints, by the way, could be an attitude. And we had some attitudes. And we had to elevate those attitudes or get rid of them. And we did. In fact, I didn't. The employees did.
How did that work? Were they like calling out other employees? Like, this person has a bad attitude?
Oh, absolutely. Yes, because they're all shared in the same profit. So they all had a vested interest into making the system work. They needed more throughput as an output without elevating costs.
Did you get employees involved in hiring after that point, or were they just more involved in enforcing the right culture?
No, we weren't at that level. At a more senior level, we did. In salespeople, because they work so intimately with each other, I didn't do that. I certainly got people involved at a higher level in the office.
Yeah.
I wasn't at that. By the way, I sold up my interest to the original owner after my 8th year in the company. His passion to keep it was far greater than my passion to buy the balance of the company. The reason why I mention that is because I suspect that had I been in this company a lot longer or bought the entire company, I suspect that my employees would have been involved to some extent with regard to the hiring process.
With the hiring,
but
yeah.
It wasn't at that point.
What about, so after you had taught your employees the importance of financial literacy and they start to understand reducing waste and being efficient, all that kind of stuff, then did you like bring them in on like a monthly finance meeting where you brought the books out and, okay, here guys, here's what we did last month. Here's our P&L. How did that work on an ongoing basis with your employees?
Okay, so I had to be very respectful to my partner, who was a generation older than myself. He was a founder of the company, and he was quite opposed to financial transparency. So I had to be respectful to him too. This wasn't my show, this was our show. So what I did was, and I recommend to anyone who's considering this all depends on the culture of your organization, the culture of your partners, the culture of your leadership in the company. One's got to be respectful. So I used the term earlier on in this conversation, not everything interesting is useful. So what we did was we disclosed on a monthly basis our P&L based on what they could control. They all knew the revenues, they knew fabric usages, they understood variable costs such as commissions and e-commerce fees and so on. We didn't include rent, for example, although they knew the rent, we didn't include it in the operating profit because they couldn't control it. So what's the point of putting rent in? What's the point of putting accounting fees in? They couldn't control it. So we call this the controllable operating profit of the business.
Okay.
That was what is used to contribute to all the other expenses. They never saw owner's drawings. They never saw, because it's irrelevant. It's of no value. They did have a say in capital costs, because they had to demonstrate if you're going to be spending money on new equipment or revamping equipment, you had to understand the link to the P&L and how this would bring incremental value to the company before we make the spend. So we had ways of actually communicating in a understandable way. So we shared relevant, not just handing out P&Ls and balance sheets.
So let's say that 1 month showed $100,000 net profit before withdrawing the owner's share and before the share that's going to the employees. So you just show them that raw number, and then you tell them that a portion of that is going to go to them?
Okay, so everything is relative. So when we showed a net number, it has to be relative as well to how much money we invested, if that be the case. Because we could have invested, say, $500,000 in equipment. Well, you better generate a heck of a lot more contribution margin to cover that cost. So they all had a say in it. They all were part of that decision-making process before the company would blow a lot of cash out the bank. That you need to understand, you can make a great profit, but how are you going to pay the bills? What are you going to pay the bills with? So slowly we got them to understand that. So all different companies are different. There are different drivers to drive profits in the organization. There are different levels of transparency that people are willing to expose themselves to in the company. But as people get used to this, you find the level of transparency tends to increase. And I've seen this with my clients over the last 23 years. As they get used to it, they realize there's nothing wrong with sharing this information.
Right. And they start to see the employees start to take greater ownership. So give us some examples of ways in which you saw employees taking greater ownership.
Okay. So, for example, I'll give you an example of a company I worked with in Germany. They used to bonus people on two elements: new accounts. Now, these were engineers. These are chemical engineers selling very high-tech chemical products to industry. So they had two kinds of products they were selling. One was a very price-sensitive consumable product, very pricey. I mean, the margins were like paper thin. The second product they sold, if you will, were their professional services. These were all engineers. And they sold the professional services, which is very lucrative. But because they were one of their drivers was on revenue, they would be pushing the low margin consumable product, generating huge revenue with very, very, very low margins.
Got it. Interesting.
So we changed. So they retained me to provide a 2-day business literacy education program. Within this, what we did was we got them to understand the principles of fixed and variable costs and the principle of contribution. I won't do a deep dive here in this environment, but I'll give you a high-level overview. But what we also did was we said, what is the contribution margin for the company and per person per month? You've only got 40. We worked on a 2,000-hour year. It's 40 hours a week times 50 weeks, 2 weeks you're on vacation. That was the base. So we said, how much contribution is each salesperson generating? Now they had about 200 and something salespeople. So what we did was we did an analysis. We found a 300% variance between the lowest contributor and the highest contributor. The irony was that the lowest contributors were selling the highest revenues. The highest contributors were selling a lot of professional services.
Wow. And they'd never realized this before.
They probably did, but they never really got the people to understand it because they were just pushing the wrong buttons. They were just using the wrong KPIs.
Yeah.
So we changed the incentive program. It wasn't incentive. We changed the measurement of success to contribution margin per person per month. Now look, we see what happened. Suddenly they became very acutely aware of how they were using their time. They also hired an administrative individual to service. I don't remember the number. It was 4 or 5 salespeople at a time. So the salespeople shouldn't be using their time on administrative stuff, chasing orders when somebody else for 40 grand a year can do that.
Right.
They became very discerning who they sold to. They started pushing their professional services rather than widgets, where they could get an administrative person to be calling to sell widgets.
Well, that's what I was going to ask about. So then did you have to change sales commission structure? And
they did.
And was that a difficult sell? Because sometimes it's hard to talk salespeople into changing their commission structure.
Sure. It was easy for those people that bought into the change. It was tough for those people that wouldn't, and they disappeared real quick.
Got it. There you go.
Because my philosophy is, are you a heartbeat or a sales professional? Heartbeats we can buy anyway. A sales professional is a different animal. So learn to sell the value of what you represent. So here's another thought for listeners here, John. I believe that when a salesperson goes out to sell, the moment the sale is made, they are part of the customer's problem. People say, look, why? I said, here's why. Because the sale represents revenue on your P&L, but an expense on your customer's P&L. At that moment, you're their problem. It is incumbent upon a sales professional to learn the language and understand the business case on how to explain and deliver the incremental gain to the customer's P&L above and beyond what it's costing. And until you can demonstrate that and actually deliver on that, you are part of their problem. That separates a heartbeat from the sales professional.
Yeah, definitely.
Order takers from professionals. And that made all the difference in the world to this company. It was a total game changer. And I've seen this happen over and over again.
Tell us about any other clients that you've worked with to implement this model, and some of the pros and cons of it, or the challenges with articulating it to the employees.
Okay. So working with the very large companies, publicly traded international companies that I've worked with, is far more difficult because they're very state in their ways. For changing the incentive program, I have been successful with a couple of them. One of them works with a ratio called RONA, return on net assets. Again, we're not going to do a deep dive in it here, but it's essentially everybody touches it. They're a $4 billion international publicly traded company. They changed their model as a result of it.
Wow.
But in the main, I've seen the positive impact of this type of concept I'm talking about. Not financial literacy. We work with a lot of large corporations in that. But in terms of changing the incentive program and changing the behaviors, because of the incentives, are scaling entrepreneurial companies. That's where I see it happening. Because an entrepreneur cannot do it alone, John. You cannot do it alone. They need to engage and embrace and make accountable and instill an accountability with all the employees. But to do that, you've got to give them a reason to change. They're not going to do it for the sake of it. You've got to get what's in it for them. By the way, money is not the only motivator, which is what I've experienced as well in the past.
Right.
It's
Well,
not the only motivator.
that would be a counter argument to this would be that, and there's a great book by Dan Pink, Drive to Sell is Human, which says that people are motivated by mastery, autonomy, and purpose, not so much by money. So that would be a counter argument people would make that, we don't need financial transparency. That's what not what motivates people. It's more they're motivated by recognition, and they're motivated by given autonomy to do their work and having the feeling of mastery over it.
Yes. And exactly to that point, by having a level of financial transparency and engaging and educating your people to work with you as a leader to make fiscally responsible decisions and participating in the gain thereof is bigger than the actual financial gain itself.
So actually the feeling of being a part of it, I guess that goes to the mastery piece then probably, as I was describing. Yeah, feeling that mastery over the business. Yeah.
Yes.
Yeah. Yes. And so getting back to what I asked earlier about, you said, you had the founder of the business in your company where he was against the full transparency. If you have a client that comes to you and is willing to go along with your vision, have full transparency, what does that look like? And again, do you have a monthly meeting with all hands meeting, all employees, going through the P&L, going through every single number? Or is it like you described earlier where you just disclose the pieces that they have control over?
It's a slow process, John. The problem that I had, and I made this mistake, is that, and I was new at this. I mean, I was totally naive. I mean, I had no idea. I bought a book about open book management once, and I read it. I thought, wow, this is a very cool idea. So I was brand new at this. I leaped way too fast and tried to convert my partner, again, generation older than myself.
Yeah.
Very old school thinking. I'm going to make 30 years ago.
Yeah.
So, and it's hard to believe someone can be older than me, but he was.
Sure.
It was a huge leap for him to go from zero transparency to opening up the book. So I had to learn to slow down as well because there was a lot of friction.
Yeah.
So if I were to give advice to anybody who's considering this, and I would really recommend this, I can tell you, I've seen it work over and over and over again. Stepping aside for a moment, Einstein's definition of insanity, right? Expecting, you do the same thing over and over again. You expect different results. It's not going to happen.
Yeah.
So if you want to sleep well at night, you need to get your people engaged, but it's a slow process. So if I may ask, let me answer your question for you. Sorry, I went around the bush on this thing. I'll answer it for you. So first of all, people ask, how many KPIs do you need? And how many metrics do you need? And my answer is the less, the better. Because don't overwhelm people with too much information. So you start this thing off real slow. The first step I do work with entrepreneurs is I get them to take my course and learn to understand learn to be financial literate yourself. Because I can tell you that the significant majority of non-financial entrepreneurs are less than 40% financially literate. Less than.
Yeah.
So what chance do they have in being successful on their own cognizance, never mind anybody else, if they don't understand the financial implications of what they do or managing expectations? So that's the first step. Then you need to get everybody else to understand the context that revenue don't mean profits and profit don't mean cash in the bank. So give them some context. It's not fair to oneself as a business owner when you see all these revenues and say, look at our boss, this guy's earning a fortune. He's generating $6 million a year in revenue. Can you imagine how much money he's making? It's simply stupid.
Yeah.
Actually, not stupid. It's naive, and it's not really fair to oneself to educate them.
What do you say to someone who says that, insert example of some company out there that doesn't have transparency and yet has managed to be successful in spite of that?
They could have been a lot more successful. And they might sleep a lot better at night while everybody else lies awake a bit thinking about it. And that also makes them vulnerable. Because there's another concept here called the deprivation test. It's not in I can't remember if I put it in the book or not. It's called the deprivation test. Deprive yourself of a resource and see what happens, including you. If you step away and want to go away on holiday for a month, do you think your business would survive? If not, you better get your act together and get people to act or on behalf of you so they can act and think like you, the owner.
Yeah. Stepping back to the KPIs that you mentioned, sorry, we're bouncing around a little bit here.
No, that's good. No, that's cool.
But with the KPIs, how do you advise a company that has like ongoing tasks? Like, what is the KPI? How do you determine a KPI for, people that are just kind of doing the work on an ongoing basis? Or, the janitor in the warehouse, their job each day is to sweep the ground. Like, how do you create KPIs for people like that?
Okay, so remember, not everything interesting is useful. So it's a question of, does the activity move the needle? So in the beginning, you've got to focus on the more important stuff that has the biggest impact, and then you can start refining it down. I wouldn't start with a guy sweeping the floor because, maybe it could make a difference, because if you sweep quicker, I can cross-train you to do something else.
Mm-hmm.
You see the way you can push the envelope on that. It's not about sweeping the floor, it's about the utilization of resources. So I can get more output with the same labor without increasing my cost. That comes across training, and I did a lot of that. So you start with the meatier stuff, and you create KPIs that can move the needle. But it's incumbent upon the person who's doing the education in the business, or the bookkeeper to be trained in this, or the accountant, to link all the dots together. Because there's another chapter in my book called "Don't Examine Numbers in Isolation." Don't examine numbers in isolation. So sweeping the floor in isolation has zero impact on the company. But looking at that number in the context of the total labor force and output has a lot of impact if you teach them how this can actually matter to their bonus program.
Yeah.
There's got to be context to it all.
Yeah. And do you find that there are certain portions of companies or entire companies that just don't take to this financial literacy? Yeah.
Yes. But the bottleneck starts at the top of the bottle, John.
Oh.
And you remember what I said, that it may be simple, but I didn't say it's easy. I really mean that.
Yeah.
It really is simple to sell it for more than it cost you. Give or take a few thousand details.
Yeah.
That's very simple. Because we're talking about a change of culture. It is a change of culture. And I have to tell you that not everyone's willing to expose their numbers. I've seen my share of it. I've had people who I've worked with, a lot of associations. They say, look, I'm just not prepared to share my numbers. I said, well, that's fine. It's not for you, and that's okay. Keep doing what you do. But then stop complaining that your people are making stupid decisions. So you can't have it all. You've got to make a decision whether you want to be transparent or not. And again, I'm going to repeat this because it's important. You don't do everything at the same time. This is a slow process, and the owner has to become comfortable sharing these numbers and realizing there's no harm in doing that. In fact, it's a huge benefit to doing that because people don't make stupid assumptions.
Yeah. Well, for me, I mean, a couple of things that you said that I think are reassuring as an owner is that you said that you don't share the owner's share. You don't explain what the owner's share of that profit is going to be. Right. And also the fact that it's gain sharing, not profit sharing. So do you want to expand on that a little bit more? Because I know maybe we kind of glossed over it earlier.
Yes.
Yeah.
So an owner is entitled to a return on their time and risk, their time and money investment.
Mm-hmm.
And the risk, I mean, they've got their house on the line, right? I mean, how many owners, I've certainly been down that road where I've put my home on the line.
Mm-hmm.
I lose this business, my home is gone.
Yeah.
You're entitled to be rewarded for that. And sometimes, and not sometimes, always, people should understand this in your business. Not necessarily numerically, but they should understand this philosophically. So in answer to your question, is that you are deserving of having a certain return for your investment in this company before you're willing to share it with your new partners, if you will. They're almost like they're your partners. They got like phantom shares in a way. Mm-hmm. They're almost like phantom shares.
Mm-hmm.
But you're entitled to a certain return before you start sharing. So if you say to yourself, look, I got $100,000 of net capital invested in this company. I'm on the hook for this. That's $100,000 worth of equity I have in this company. Being a privately owned company, I expect at least a 25% return on my investment. I can get 10% any time of the day on bridging finance for mortgages, and I have good collateral. I deserve more for the risk that I'm taking because it's all about risk and reward. And I'm just using arbitrary numbers here. So you can say, look, I expect 25% return on my investment, and after that, I'm willing to share 30% of the gain with all of you. I think I should get 70% because I'm taking the bigger risk here, but I'm willing to share 30% with all of you, anything above that, in whatever proportion you like. Now, I think that's completely fair, but it's up to you to come up with those numbers and come up with a percentage. I shared 50-50 because we were in such trouble and we had 400 people. And in the absence of giving them something meaningful, this company would not survive.
And do you find that when companies unveil that number, that the employees are grateful because it's something that they didn't have before, or do you find that they push back, and is there a benchmark for what that split should be?
Well, there's no benchmark because it's entirely up to you, but you've got to go back and ask yourself, and you remember, you've got to use the SMART principle. It's got to be, if you heard of the SMART principle, it's got to be specific, measurable, attainable,
right.
etc. You've got to ask yourself, is it fair to ask them to bust their heads over this to earn another $20 for the year? I mean, that would be ridiculous, right? I mean, you're not going to go to the wall here for $20 a year. So you've got to ask yourself, is the objective, is the target that we're aiming for realistic? Is the share going to be worth their while? Now, for somebody who's earning, say, 50 grand a year, if they can make $2,000, I think that's pretty meaningful. That means a vacation for them or whatever. That's pretty meaningful. If somebody's earning 200,000, $2,000 is not particularly meaningful. So you got to get a perspective what is meaningful to people. Okay, there's another perspective here, something which I did, and what I did was I paid supervisors and decision-making people in the company, what I call the influencers. I paid them double the bonus. However, the additional portion came out of the company's share, not out of the employee's share that was being split. So there was no conflict of interest.
Oh, interesting. So it came out of your amount for the supervisors. For
what I call decision makers or influencers. Choose your own language, however you want to feel. Because I feel they were taking responsibility for those people under their wing, people who answered to them, and they were responsible. So they got double the bonus.
Got it.
There was no jealousy because it wasn't coming out of the employee's pool and I wasn't impacting them in any way.
Got it.
So it also encouraged people to grow, because if you want to get double the amount, then increase your skill set and take on responsibility, and we will pay for it. We will educate you to do, and we did with a number of people. Sent them on supervisors courses and training courses. We paid for it.
Ah, interesting. Well, we're running a little short on time here, Neville, but this has been really interesting and informative. I want to ask two questions to wrap things up. First, I want to ask, I'm a big fan of gratitude. And as you look around at, other peers, maybe others in your industry, others who are teaching financial literacy like you have, who is it out there that you admire or you respect the work that they're doing?
I know this is a bit of a stretch here because I always look at, they have lots of mentors. My three sons who are fabulously successful, I look at them as mentors in certain ways. I'm so jealous of their age of growing up now. But one person I've always looked at, and I have the most unbelievable respect for him, is Richard Branson. The guy's dyslexic. He's been knighted. He runs like 2,000 companies. He has a totally transparent environment of engagement and embracing people. He just loves the people that he works with. He's just a remarkable individual. And I've often tried to take pages out of his book, if you will, his proverbial book, to follow his example of authenticity, openness, vulnerability. He demonstrates his vulnerability. I say things are wonderful leadership attributes, and I try and follow a lot of those in my own practice.
Yeah. Why do you think he's been able to start so many companies and manage so many companies, oversee so many companies?
He delegates. And that's exactly what I was talking about earlier. You cannot do it alone.
Yeah.
He is not the constraint in his company. So when we are the product, we are the constraint. You need to elevate the constraints so that your people, your system becomes a product, not us as individuals. And that's what he's done very well.
That's great. And then last question, final question. Let's pretend we're at an awards banquet, much like the Oscars or the Emmys, and you, Neville, are receiving a Lifetime Achievement Award for everything you've done up until this point. What we all want to know is, who do you thank? In addition to family and friends, of course, we'll always thank them, but who are the colleagues, who are the mentors, peers, business partners, who are the people that you would acknowledge in your remarks?
Well, the people from way back when was my old partner, who actually changed my life, not only about what he did that was right, about some of the things that I disagreed with him on. And it helped me elevate myself. And I've done lots of wrong things myself. So it's not to say that I don't do things wrong, but a lot of his philosophy of thinking, which was very narrow at the time, taught me how to get above that. It taught me wonderful skills. So I'll be everlastingly grateful to him. My wife of 43 years, one needs a partner, whether it be your wife or somebody who you can lean on, who's not going to judge you all the time. I think is really important. My wife and certainly my boys have been, I know it sounds all corny, but it's happened to be, for me, it's been very true. I'm an avid reader. More of late, I'm sharing this book. Let's see my screen here.
Love is Just Damn Good by Steve Farber. Yeah. Steve
Farber, wonderful guy. I've met, I know Steve, I've attended his conferences. His latest book is called Love is Just Damn Good Business. Now, love is different. Loving your pizza, loving your wife, and loving your business. They're different kinds of love. But he advocates embracement and love of what you do in your company and creating that kind of culture. And I'm a strong advocate of that. And when I met him and I saw his book, and I bought one for each of my boys, and I bought them for clients as well, it embraces the philosophy. He doesn't talk about financial literacy per se, but the culture of what he does, to me, is just way up there. So I love this kind of thinking. I'm an avid reader, and I certainly suggest to our listeners to read and learn.
Great, Neville. And where can people go to learn more about you, connect with you, and learn more about what you do?
In case you didn't notice, I love a good debate. I love a good discussion. I'm very passionate about what I do. So let them contact me at Neville, Neville, at BizWisdom, BizWisdom.com. Neville at BizWisdom.com. I'd love to connect with you. I'd love to get you a copy of my book.
Yes, it's great.
And have a chat with you.
The Baker's Dozen Rules of Highly Successful Business Operators by Neville Joffe, forward by Brian Smith, the founder of UGG. Very cool. Yeah, Neville, thanks so much.
You're welcome, John. A pleasure speaking with you.
Thank you for listening to the Smart Business Revolution podcast with John Corcoran. Find out more at smartbusinessrevolution.com. And while you're there, sign up for our email list and join the revolution. Revolution. And be listening for the next episode of the Smart Business Revolution podcast.